So what is it going to take to get you pre-approved? You may be asking yourself, what documentation do I need? How much money is it going to cost me? How long does it take to get pre-approved? I'm going to answer all of these questions and walk you step by step through the pre-approval process. And hang on, because I have a pro tip at the end that will dramatically increase your chances of getting an offer accepted when you're ready to make an offer on a home. In order for you to make an offer on a property, you're going to need to get pre-approved first. Every seller out there is going to want to know that you can actually afford the home that they're looking to sell. It makes sense. A pre-approval letter should not cost you anything, although some lenders will require an application fee. I don't recommend you pay these. The reason some lenders want an application fee is a little known secret in the mortgage industry. And that secret is that just because one company does your pre-approval does not mean you need to use that company to actually get your financing when your offer gets accepted. So what they want to do is charge you an application fee to help prevent you from actually going elsewhere when you get your offer accepted. Now, a pre-approval should be good for about 120 days. The reason is your credit report will expire in about 120 days. But be very careful here, because a pre-approval is really only as good as the information that it's based on. An example would be if you get pre-approved in October, but then lose your job in December, well, that will void the pre-approval because you no longer have the same employment. Or if you got a pre-approval, but then had to get a car and took on a new car payment, that could, in theory, void your pre-approval if now your debt ratio is higher and you don't qualify anymore. So as long as your income, credit, and assets stay the same, your pre-approval should be good for about 120 days. But anytime something changes in your pre-approval, make sure you contact your lender and let them know. Okay, so there are 4 main parts to a pre-approval. The first part is going to be all your basic information. The second part is your income. Third is your assets. And fourth is your credit. I'm going to walk you through each of these, tell you what questions you will likely be asked and what documentation you're going to need in order to complete the pre-approval. The first part of the pre-approval is your basic application information. We will need this for you and anyone else who's going to be on the loan with you. This is everything that you might expect and you'll already know. For example, your name, your address, your date of birth, and your social. If you are a junior, make sure you enter that information in there. If you've been at your address for less than 2 years, you will likely be required to add your previous address. And you always want to make sure that your date of birth and your social are accurate, so double check those because they will get picked up on a credit report. Next thing we're going to ask you is about your marital status, if you are married or divorced. Not because we have a cousin that's interested in dating you, but because we need to know that if you are divorced, are there any child supports or alimonies accompanying that divorce? Also, if you are a veteran, there will be a place for you to put your veteran status. Thank you so much for your service. If you are a veteran, as you may or may not be aware, veterans have the ability to use their VA benefits when purchasing a home, so it's crucial that we know this information up front. Same thing goes for first-time home buyers. There will be a certain place for you to put if you are a first-time home buyer or not. This is very, very important information for us to know because there are certain first-time home buyer benefits out there now, including discounted interest rates. The second part of a pre-approval is your employment information or your income. So we're obviously going to want to know where you work and how long you have been there. If you've been there less than 2 years, be prepared to add your previous employment information. Now, it is a common misconception that you need to be on your job for 2 years in order to get pre-approved. This is not true. If you have a base salary and the lender can verify that you've had that base salary and it is likely to continue, more than likely you can use that even if you have had that job for less than 2 years. The next piece is you're going to need to add in your salary or hourly wage information. So if you have a base of $100,000, you would add a base of $100,000. If you make $25 an hour, you're going to add $25 an hour. You will also need to add any variable income that you have. Variable income is any income above and beyond your wage or your base income. For example, bonus, commission, overtime, and shift differential are examples of variable income. Now, when it comes to documentation, most lenders are going to require pay stubs, maybe W-2s, and likely a verification of employment. A verification of employment is where we send out information to your employer or to a third party to verify that you're actually working there and what your income actually is. So we can verify it through the pay stub, and we can also verify it through a verification of employment. Now, if you are self-employed, this is where things get a little bit trickier, but still very easy to pre-approve you. If you are self-employed, you do need to typically be self-employed for more than 2 years. Also, it's a little bit tricky when you're filling out the application because we ask you how much money you make, but we're actually going to use your tax returns to qualify it. So the documentation that you typically need when you're self-employed are your tax returns, either your business tax returns or your personal tax returns, depending on how you file as a business. Now, when you're filling out the application, most people are just going to put what they received for income, and then the lender will calculate that out income once the documentation has been received. The third part of a pre-approval is your asset information. There will be plenty of places on the application for you to enter all of your assets. Lenders need this information because we need to know where your money at closing is coming from. For example, we need to know what assets you will be using to cover your down payment, closing costs, property taxes, homeowners insurance, and any other money that is owed at the time of closing. Assets could include, but are not limited to, liquid assets like checking, savings, stocks, bonds, mutual funds. All of those can be verified through documentation like bank statements. Okay, we can also use retirement accounts like 401ks, IRAs, even pensions. Again, all easily documented, typically with statements. The last most common asset is a gift. Now, in lending, if we can document where the gift came from, we can typically use it. It's important to also note that if you are getting a gift for, let's say, $10,000, you don't have to receive that gift at the time of application. Meaning we can actually add it to the application, but then document it later on down the road when you get your offer accepted on a home and then receive the gift at that time. But a rule of thumb when it comes to assets is we can typically use it if we can verify where it came from. The fourth and final part of a pre-approval is the credit pull. Every single day somebody asks me, does this affect my credit? It depends. There are two types of credit pulls. There's a hard credit pull and a soft credit pull. A hard credit pull will pull all three credit bureaus, which is Experian, TransUnion, and Equifax. And yes, it can have a slight impact on your credit scores depending on how the rest of your credit is. The other type is a soft credit pull. This has less information on it and will not impact your credit. You need to ask your lender if they allow for a soft credit pull. Most of them will, but may not issue a full pre-approval with a soft credit pull. Okay, now lenders need to run your credit for a couple different reasons. There's a lot of information on our credit report that we need. The first piece of information, as you might expect, is your credit scores. Mortgage companies have minimum credit score requirements, so your credit report will tell us what your credit scores are. The second piece of information is your pay history. We will see what type of accounts you have. For example, credit cards, student loans, auto loans, and personal loans are examples. We're going to see what types of accounts you have and how you pay on those accounts if you pay them consistently and on time. We will also be able to see other things like prior bankruptcies or judgments. And then the last part of a credit report is that helps us figure out your debt ratio. So not only will we see how you make your payments on things, but we will actually be able to tell what those payments are, which ultimately we will add up to figure out what your debt ratio is. And a debt ratio is just a number that helps us determine how affordable your mortgage is going to be for you. So now that the lender has all of the vital information, meaning your basic application information, your income, assets, and your credit, accompanied with all of the proper documentation to verify all of that, we should now be able to issue you a pre-approval so that you can go make an offer on a home. Which leads me to my final pro tip. Before I give you my pro tip, I'd love for you to tap that like button and join my family of subscribers to see more incredible videos like this one. So my pro tip of the day is skip the pre-approval altogether, which you may think is crazy in the fact that I just gave you all that information about a pre-approval and I'm now telling you to skip it, but you should go right to an approval if your lender allows for it. Typically, mortgage companies have loan officers like me doing your pre-approval. But these days, it's become so competitive for buyers that lenders, like Guaranteed Rate, are now allowing their buyers to get an approval up front. An approval is stronger than a pre-approval, and the thought process is that if our buyers are out there shopping around with approvals, they have better chances of getting offers accepted on homes. I highly recommend you get an approval. If they won't, please reach out to me. I'm happy to get you one. This is going to give you a much better chance of getting an offer accepted on your first home.